What's up, guys? Thanks for tuning in. Let's jump right into today's first trade, a long scalp. Unfortunately, this one didn't turn out as planned, and I only broke even. Consequently, there was no profit on this particular trade. Obviously, not all my trades are winners. In fact, and as I've mentioned before, my success rate hovers around 70 to 80%. And here now we can briefly talk a little bit about the importance of risk management, which in trading is the secret, in my view anyway, is the secret to staying profitable. I do believe that risk management and stop loss are both critical tools for making successful trades in the market. By understanding how and when to use these strategies, as well as identifying the risk tolerance that is right for you, we as day traders can protect our profits while also trading in ways that yield solid returns. Risk management prevents potential losses in case of sudden setbacks, while stop loss helps mitigate long-term damage with a more disciplined approach by quickly cutting your losses. Using both correctly, I think, can make the difference between making good money on the market or watching your account disappear with unfortunate trades. I truly believe that experienced traders do understand that good planning and effective risk management leads to greater profits. And here, guys, please, particularly to those of you out there struggling right now with your trading, please do not let emotions overpower your logic. Put your money where your analysis is and use risk management to protect it. I think that if you can stick to these basic yet critical trading rules, you will be successful. Now, getting back to the trade, the main draw for this particular entry was this 5-minute imbalance zone, which I noted as soon as it was breached. Besides the obvious balancing factor of this move, another thing that caught my attention about it was the supply side's weakness aspect, meaning we have this very thin candle here with this tall wick at the bottom, which shows that the bearish momentum is stalling. And as you can see from the chart, after the market shifted its directional bias, the price staged a strong bounce off of the 40-45 level. Clearly, this helped to alleviate some of the oversold conditions that were initially present. The uptrend gained even more traction after this break in market structure, which did open the door for further upside. So we have a clear upward move here unfolding, which does suggest that the next wave higher is about to begin. That said, though, we should first be able to pump through this resistance area at the 40-54 level and hopefully stay above it. I think that this is a key level to watch, and if we break it, it would suggest that the move toward the upper levels of this trading range is more likely to stick. Now, based on this premise, I decided to enter the market long at the 40-51 level, assuming that prices would pull back. So after getting filled, the price resumed its uptrend and attempted to break above the 40-54 area, but obviously failed as it did not have enough power to sustain the move. As a result, I closed the trade at break-even, which including commissions ended up being a red one. All right, with this trade done, let's move on to the next one. So this is another long entry I took, as you can see from this 5-minute chart. The market initially spiked following the CPI report that showed a better than expected reading in November. Obviously, I'm referring to the December 13th session. However, the rally lost much of its steam as the session went on, with the market nosediving in nearly 160 points, as you can see from the top here, before finding a base right above previous day's high. The price then reversed and started to rebound. And let me switch here real quick to a 1-minute time frame. So after this shift here, we have these higher lows printing the tape. These are then followed by the formation of an order block zone, which, as you can see, leads to a price consolidation phase below the 40-60 level. Now, before we get to the next part of this brief trade analysis, I think it's essential for the noobs to understand what an order block zone is. This type of zone occurs when the market experiences a sudden change in orders and trades due to large institutional players and high-frequency trading firms submitting larger than normal orders. This structural market element is usually reflected by impulsive moves or rapid price fluctuations before it settles, leading to the order block zone being formed. Once that formation is completed, it creates a new and important dynamic in the market. I think that based on the progression of these trades patterns, the pieces of the puzzle are, in my view, coming together for a bullish case. And what I mean by that is that after this double top here, a 35-point price decline finds a base at precisely our intended order block zone. Furthermore, with no signs of a sharp counter trend momentum move on this price deterioration here, we can speculate with some level of confidence that with this type of accumulation, this market is poised for a move higher. And guys, I also want to point out here that basic economics obviously plays a major role here, since it teaches us that when demand goes up in a well-structured market, prices will too, as the market looks for a new price equilibrium. This is one of the ways that price change happens. Over time, higher prices will attract enough shorts to the market so that a new balance can be reached, even if it's only temporary. So based on these indications, I decided to enter long. The market's break of structure occurred right around my entry point, as you can see more clearly in this 50 seconds time frame. And by the way, guys, if you want to learn more about order blocks, check out this video. Alright, with that said, thanks for watching and hope to see you in the next one.